Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like. But that's the main point to take away. Let's see how serious Moody's downgrade is for the U.S. debt. I'm very interested to hear what Rob has to say about that. So let's get right into it. Rob, you out there?
I am Zach. How are you? Happy Tuesday afternoon to you and everybody tuning in. Gosh, there's no limit of the amount of chatter regarding this Moody's downgrade. And as you might imagine, if you've seen me before, I have my opinions on it. Rather opinionated person. So I'll go ahead and share my thoughts with you. And as a reminder, one of the things that was talked about during this Moody's downgrade is the effect on the US dollar and therefore putting a renewed bid into gold. If you haven't registered as of yet, we have a big event tomorrow with Jeremy Blossom, who's a senior market strategist at Advantage Gold. He had a visit with a gentleman from Harvard who was actually instrumental in helping central banks around the world form themselves from the Federal Reserve, use them as a guide. So he's got a lot of insights into what the Federal Reserve is doing for gold. If you've heard me on any of my Federal Reserve rants, you know that's right up my alley. And I know the general thought process is, oh, yeah, well, gold goes higher over time. Well, there's some specific details in this event. We had a meeting yesterday to go over the outline of the event, and it's going to be amazing. It is well worth your time. So, Zach, if you wouldn't mind putting that link in the chat box one more time. If you haven't signed up for it, please do so. If you have a U.S. phone number, and you do need to put your phone number in, if you have a U.S. phone number, you get a free gift. If you don't have a U.S. phone number, you can still attend. You just don't get the free gift. And unfortunately, based on the regulations of Advantage Gold, you aren't able to do business with them, but you can still gain the information if you want to attend the event. So please sign up if you haven't already. I'm more excited about this webinar than I have been in a lot. Obviously, when we're doing the Elliott Wave options events, I'm always excited about that because that's my company. But this one, as far as an ancillary event, is going to be really exciting. In fact, just yesterday in our conversations, I gathered a tidbit that I didn't know. So I imagine there will be things that no matter how much you think you know about gold, you will find interesting as well. So please sign up and join us tomorrow at 7 p.m. Eastern time. All right, let's take a look at the markets. And I just want to let everybody know a little bit ahead of time here that we will stop a little early today. We're not going to go to 2 o'clock. I'm going to talk until 1:30. Then we'll do a Q&A for 10 minutes. And then Zach will post the case study consideration for this week. And I need to be on a hard stop at 1:45 due to prior commitments. So with that, let's go ahead and get going. I'm going to talk rather fast, but once I get to 1:30, I will leave time for the Q&A. That's part of the community aspect that we have here at TradeFinder, and I don't want to diminish that. So with that, let's take a look at the S&P. The news was the Moody's downgrade that came Friday after the close. I guess they felt like maybe that was going to be a really significant event, but two sides, there's always two sides, right? So the first side is the fact that Moody's is a third of the major three credit agencies to downgrade the U.S. debt. The other two, Standard & Poor's and Fitch, et cetera, have already done that and did it years ago. We're going to actually show you in tomorrow night's event what happened to the markets following those. I think you'll find that quite interesting because as a technical trader, we look at what's happened historically with similar setups. So we'll go through that. And so that'll give you an aspect beyond just what gold's going to do as far as what the markets are likely to do. And so, you know, some people dismissed it, myself included, as old news. And it is because they were the last ones to downgrade the debt. We know the debt problem that we have. I'm going to go through all that. The market seems to have shaken it off pretty well. We opened lower yesterday, traded up and closed on the high of the day. Today we have a little bit, so far at least, a kind of a consolidation day, low volatility intraday. We are a little bit above the 10-day moving average. We're also in a grander scheme in this no man's land. Last Monday we gapped up based upon on the 90-day pause of massive debts, the talk about relationships going much better with China and talks going better, agreements in the works, etc. I hate the fact that we gapped through a major point of resistance like 575, and I don't like the fact, and this is a little counterintuitive. If you've heard me before, you know I like the market to move in a 45-degree angle, which we're doing. I would have preferred to see the break on Monday, a follow-through day on Tuesday, and then come back and test that level. And I still think that's a likelihood that we test that 575 level. Is it now support as we broke through it in resistance? So I would have preferred to see over the last few days a move back down towards there. I would have felt far more constructive to the market moving to the upside. On the other side of the coin, we are in this kind of vacuum area here where we had a pretty big move down from 610, where the wave 5 high existed in February, down to that 575 level. So there's no resistance in the way. So could we continue just marching up to that 610 level? We could. I just feel like it would be more constructive to a longer term bullish move in the markets if we had retraced sooner. You don't always get what you want. Zach, we've talked about this before. We need to change our music thing from Led Zeppelin's "The Song Remains the Same" to "You Can't Always Get What You Want" from the Rolling Stones. And that's what applies here. I just think you need to be a little wary that at any time we could head back down and test this 575 level. So a corrective move down to 575 wouldn't worry me at all from a bullish standpoint. I would feel like that's actually constructive to the fact that a further move higher has a greater chance to hold. But we could run up to this level, and maybe at that point in time, we get a bit of a correction, and that correction could be a little more severe than had we corrected sooner. But again, we have to trade with what the markets are giving us rather than what we would like the markets to do. That was a mistake I made in my early days of trading. The more I learned about the markets, the more I felt I knew where the markets were going to go or where the markets should go. But then the markets reminded me they're boss, and the markets are going to go where the markets are going to go. So you can choose to listen to what the markets are telling you and what they're doing, or you can choose to listen to where you think the markets are going to go. And that was what I was doing. I think you obviously know that the results probably won't be as good if you trade on your own thoughts versus what the market is telling you. So we'll have to see where that plays out. Let's get to the other major markets on the weekend update. Again, travel plans. We're in demand at LA Wave Options at ewotrader.com, and I'm getting all these opportunities to speak and do events, and so it's flattering, and that happened on Friday as well, so I wasn't able to do a full U.S. market update, so I'm going to run through these markets rather quickly. I do like the setup on the DIA better than I do on the SPY. We did have a gap up, but the difference was on the DIA, we gapped up to resistance. We didn't gap up through resistance. And then we had some backing and filling, and we came back and filled that gap. I wish we would have done that in the S&P, but we didn't. So we live with what the S&P is showing us. So I think, personal opinion only, that with all this clean air, perhaps regardless of what happens in the S&P, we have an opportunity over the next few weeks for the DIA to outperform the SPY. We'll see how it plays out. Just because it's my viewpoint doesn't mean a thing. Again, the market's going to do what the market's going to do. Now let's move to the Qs. And the Qs are actually consolidating. And one could argue this is the best of all scenarios, that, you know, we had that gap up from 525 down to 500 was a pretty vertical move lower. And we moved straight up to 525 again. And so that's expected. That's what happens when you have no resistance in the way. When you have a vertical move down from support and build new resistance, it doesn't leave much as far as resistance moving back to the upside. And so this nice consolidation here underneath the resistance level, again, two different scenarios. And some people say that, oh, you don't make specific market calls. Well, if you're a trader and you're not taking into account what could happen if you're wrong, you're not going to be a successful trader. You're not going to last very long. So I can talk about where I think things are going to go based on the technicals, and I don't view it on my own thought process anymore. I view it on what the market's showing me. But if you aren't prepared for what to do when the market goes wrong, then you end up with big losses. So this consolidation here under 525 oftentimes means that we are setting up, allowing the 10-day moving average to catch up for a break of 525 and a run up to that wave 5 high. That could be a great scenario. So we could have gone through a corrective phase following the completion of that wave 5 and we move up. It will likely relabel. It probably won't stay a wave 5. This would probably relabel to a wave 3, but still give us a target around the area that was viewed as a potential target back here at the beginning of the year. And then the other side of the coin is, well, if we consolidate here but don't break 525, then we may come back down. But on the bullish side of things, if you like to look at the market from a bullish standpoint, you are liking the fact that we're consolidating here. If we had broken 525 on this run up, I feel like that probably wouldn't have held. At this point in time, we do have a chance for it to hold. So looking at the IWM, that was our case study consideration last week. Not a whole lot has happened since we added that as our case study consideration last week. We still have a wave 4 that is qualified on a 5-wave to the downside pattern at 53%. I do really like this consolidation here above the 10-day moving average, and I still feel that the IWM, because of this move down from 220 to 200, has very little resistance in the way to move up to 220. So if you're wondering, how do you feel about that case study consideration from last week, I still feel this is a good place to be. And if the markets calm down, that we could continue higher in the IWM. So how do the markets calm down? Well, the first thing we need to do is go to the bond market, because that's the problem. That's the fly in the ointment of all the charts, and the potential moves higher in the vacuum areas, etc., is being negated, in my opinion, right now, because the bond market is not acting well. The bond market seems to be more concerned with the Moody's downgrade than the equities markets do, and we're moving back down, and look where we are. We're back at those lows from January that were tested again in April. This is our third test here, and for some of you that have known me for a long time know that when I first started trading, I did extremely well. I made a whole lot of money in a relatively short period of time. And just from the human nature, that really plays into your ego. And you think, oh, man, this trading is for me. I'm a natural, and this is where I need to be. And then the market decided to let me know who's boss. And it doesn't always work that way. And I gave a lot of that money back. And so then I quit trading for a while and decided maybe I should find someone that's been around a while, a mentor, if you will, that has more experience than me, and learn from them. And my personal mentor focused on this exact situation here. And one of his viewpoints, one of his rules was the third time's the charm. So we came down here and tested it in January. We tested it in April. We're back down here again in May. This is the third time we're testing this level on the TLT as far as prices on bonds and therefore yields going up. And his rule was, what happens on the third test of support or resistance tends to carry through for the short to intermediate term. In other words, if we're to break this level, then we're probably going to continue to go down in prices and bonds and continue to go up in yields. Or if we hold this level and bounce up, that bounce is likely to continue higher over the short to intermediate term. So based on the rules of the mentor that I followed, we're at a very important inflection point in the bond market. Where we go from here in interest rates over the next week or two is going to be really important, in my opinion, on where we go from the equities markets moving forward. If we take a look at the VIX, we're kind of stubbornly holding that 17.5 level. We got below 22.5. That's encouraging. And if we can break down below 17.5, then perhaps we can come down to 15, or maybe even the lows they go back to December of last year at 12.5. But we have to break 17.5 first. And at this point, we haven't been able to do that. At this moment in time in the recording, we're at 1770. So we're still holding above this 17.5 level. If this acts as support and we start to bounce up in the volatility index, the VIX, that's likely that the equities markets are going lower. So take your viewpoint on the Moody's downgrade, all things considered, into account. Let's take a look at the dollar. If we look at the dollar, this is one of the things we're going to talk a lot about the dollar in tomorrow night's webinar on what is likely to happen to the dollar moving forward. There's some evidence that some foreign countries are diversifying away from the US dollar. That's bad. We don't want that. You've heard me talk about how we didn't want to lose the dollar back here in April when we were breaking lower. We need other countries to view the dollar as the bastion of last support, if you will. We need them to continue to buy our dollar so that we can continue to support the rising debt that we have in the U.S. President Trump this morning was trying to calm the markets, and I think he was talking to the bond markets on the fact that with these investments that he was able to secure from the Middle East, et cetera, are going to help the debt situation in the U.S., that even if it takes time to change fiscal policy here and move towards balancing the budget, in the meantime, we have some money coming in. The bond market isn't quite buying it as of yet. The dollar isn't quite buying it as of yet. If we break below this 100 level, okay. But what would concern me is if we break back below this level here, down around 98, 98 and a half or so, because that's where we were with the wave 3 low. Notice that the Elliott wave algorithm, and by the way, if you haven't gone to hub.com and gotten a piece of this software, I don't know what you're waiting on. You get free Elliott wave. You do have an opportunity to subscribe to the AI signals. You don't have to do that. You can get the software for free and the Elliott wave labeling for free, and they created their algorithm based on the exact algorithm that Ralph Nelson Elliott wrote. There's a lot of other Elliott wave software programs out there. I acknowledge that, and I've tried all the ones that I know to exist. But most of those are personal adaptations of the Elliott wave algorithm. The Hub organization chose to say, we're going to stay purely to the algorithm as Ralph Nelson Elliott wrote it. So you can take your viewpoint on what you think as far as Elliott wave moving forward. But in this algorithm, it's saying the wave 4 is not confirmed as being done yet, which would be a good thing if the dollar were to bounce back to the upside. I want the dollar, as you know, to stay between 100 and 104. I think that keeps it from being too strong, where it hurts internationally traded companies from the exchange rate, and it doesn't fall apart. But there's still danger based on signs of what other countries are doing that we could have a further move down in the dollar. So we need to be aware of that. Talking about gold in the event that we're going to have tomorrow, we're getting a renewed bid, and likely on the Moody's downgrade, that's going to keep the bid there. How high does gold go back to the upside after such a significant run that it's had since January remains to be seen. Big move up. A consolidation here. We came down, we tested the 50-day moving average. At this point, we've held it. The wave 4 is only at 32%. I would have liked to have seen it come down a little bit more, maybe even broken the 50-day moving average and scare people out of gold, because then we have a further move higher. But at this point in time, holding the 50-day moving average and having a wave for more than 30% is something that we need to pay attention to as far as a continued move higher in gold. Silver, been waiting on silver to break out. You've seen this chart numerous times. We're in a huge symmetrical triangle in SLV, and clearly silver has not kept up the pace with gold. Does silver break out and outperform gold and catch up? Or what was seemingly a possibility just a few days ago with gold coming back down is maybe gold was going to come down and meet silver at a lower price rather than silver turning and moving back to the upside. So we'll keep that in mind. And then if we move to the crypto space, and this is a perfect example of how the risk people are looking at the dollar. As you know, there's multiple views in the crypto space of the future of cryptocurrencies, whether or not the digital currency will replace the US dollar, if it's viewed as a risk on, risk off trade, or if it floats out on its own. There's varying opinions from what I've learned, and Zach knows a lot more about the crypto space than I do, but there's varying opinions on what can happen here in the crypto space. But the bottom line is, I just look at it from a chart standpoint. We broke above this resistance level here that went all the way back to November of last year. And again, because we had a big move down in February, there was no resistance in the way, and we're back to that resistance level. It's another one of those third time's the charm thing. If we break above this resistance level, Bitcoin is likely off to the races. And for those that, and I think the younger generation is maybe moving more towards cryptos than gold. But I think if you watch that event tomorrow night, it might change your opinion a little bit on the value of having gold, at least in your retirement account. I don't want to give you the entire event, but I just want to give you a sense of urgency on attending that. Then we look at Ethereum with the ETFs. And so we look at the ETFs here. And, you know, I've made in jest comments on the U.S. market update that these are ways to trade the crypto space without having to go out and spend $100,000 on a crypto coin. I know you can buy partial coins. I'm not stupid. And I may not be an expert in the crypto space, but I know enough to know that you can do that. But if you're looking for leverage in the crypto space, this is the place to be. You want to look at these ETFs that have options. So options give you leverage. And if you have a viewpoint that Bitcoin or Ethereum is going to go higher, this is where you want to be. This is a better way to trade it. And so we ran up to this short-term resistance level on Ethereum. Big move up here. Is Ethereum going to still be a permanent player, a prominent player? Is XRP going to take over for that? I know there's a lot of chatter about that in the crypto space. But regardless, look at these ETFs with options that give you some leverage. And if you're not a fan that Ethereum is going to continue higher, then move over to that BITB and stay on the Bitcoin, because Bitcoin is still king. You can argue all these other meme coins and even XRP, etc., but Bitcoin is the king for now. Maybe that's the end of the move in Ethereum. Maybe just made a quick vertical move. And that's it. But so far, we are holding the 10-day moving average on Ethereum, so it's worthwhile to take a look at. Then we move over to the energy space, and if we take a look at UNG, as far as natural gas, you're probably aware that natural gas didn't look like it was going to give us that wave 5 move, but we're having a good move today. Maybe it's just to fill this gap that occurred yesterday. But for me, we got to get back above 17.5 before we can start being bullish on natural gas. So for now, it's in no man's land. If we break below 15, then it's a short. If we break above 17.5, then I think you can go long natural gas again. And it goes back to now we're having commentary in the financial markets that some of these companies are saying, well, maybe we will build more of the data centers. They've been wishy-washy, which has really played havoc with natural gas. The viewpoint and what put the bid in natural gas was the data centers being built and running on natural gas. And then we had the tariff stuff, and that put a move down with companies saying that maybe we're not going to build as many data centers. Maybe we're going to hold off on building them. Now they seem to be walking back on that. But we got to get back above 17 and a half. And then looking at USO, if we take a look at the oil market, I've been traveling a lot lately, as you know, and I can tell you from traveling in automobiles, there are a lot of cars on the road, a lot of cars. And I have moved my support line down from 65 to 60 because that's what the charts told me to do. Based on the low in April, we tested that with a higher low here in May. We have a nice symmetrical triangle here in USO. Maybe that continues to hold and we break out. But I don't think the breakout is going to be real significant. It's tempting to put a strangle on here, but I still think that any breakout is going to stay in this trading range. We're in the sweet spot right now, around 70, and I say sweet spot as far as prices are a little bit lower at the gas pumps as we head into the prime driving season, and it's also high enough that OPEC's like, okay, we can deal with this. We're still making a nice amount of profit, nice amount of revenue off of oil, and we're not high enough to where we're going to entice people to run away from oil and get to electric vehicles. That's the one thing OPEC wants to avoid. So I'm going to show you this chart of FXI here, and just to give you a heads up, Zach, this is going to be our case study consideration for this week. I do feel that China, based on the commentary between the White House and China, that they're at least talking about creating a long-term agreement, whether or not you think that they're on that track exactly yet. But President Trump did pull back those 145% wild tariffs on China. And if there's some sort of a deal struck, there isn't really much resistance between where we're trading right now and 37 and a half. So I think that's where we go on FXI. So that's going to be our case study consideration for this week. It will be a post, even though I'm not getting confirmation yet from the DMI. This is going to be because of the fact that I believe that a good trader has a blend of fundamentals and technical analysis. So I do like the DMI. It's not giving us the confirmation we'd like, but the CCI is. And as you know, the DMI is more of a lagging indicator. The CCI is more responsive. We came down, we hit 100, and we've curled back up. So there's not a lot of room between where we are and 37 and a half. So I think we need to spend more focus on where the CCI is. And it's telling us that there is some short-term momentum behind this. And then if you like money flow, which I do, it's the third of the primary indicators I like to look at. Look at the money that's coming in to the FXI, the cash flow, the money flow, if you will. And so it's backed by that as well. So it's backed by both the CCI and money flow, even though it isn't quite backed with the DMI yet, but we could get up to 37 and a half before the DMI gets its act together. All right, Zach, right at 130. Holy cow, I hit it spot on. You know that never happens. So let's take a few questions here, and then we'll let the folks see how you show them one of the other great aspects of this software at Hub, the social media platform. You have Discord and you have Reddit and you have all those other things. I like the social media aspect on the Hub software because these are committed traders. And based on my own experience, especially during this TradeFinder group, you guys ask great questions, very educated, intelligent questions, and you look for stocks. You're obviously looking around for possibilities. Why wouldn't you want to be on a social media platform where you have like-minded people that can give you their opinions, understanding, and their people are very prudent in their comments. Nobody's trashing anybody else. There's no making fun of any other person's ideas. So you post your idea and then you let other people give you their opinions. And Zach, you're always good about saying that opposing opinions is what makes markets. It's one of your mantras every time you do that. So sorry to steal it from you here. But that's really important in the fact that you want to see, it's natural, it's human nature. We want to see what other people think of our ideas. And so it's a great platform. And Zach will show you that in a few minutes. But Zach, let's take a few questions here first before we get there.
Sounds great, Rob. Yeah, we'll get right into it. We got a couple, well, a number of symbols rather from Raphael. So I'm just going to give you the first two. First one's going to be Lumen, L-U-M-N.
Well, gosh, we haven't looked. See, that's why I like this show so much. This one we looked at often in the past. We haven't looked at it for a while. You can clearly see why in the chart. That's about as ugly as it gets on the way down. And one of the things that I talk about a lot is that when a sector is moving, what smart money will do, what the institutions will do, is they will look for the underperforming stocks within a sector, and those can create a bid. When you look at this from a purely Elliott wave standpoint, the wave 5 finished exactly in the middle of the tap box. I mean, as spot on as you could get. And it consolidated there. And we hit the low in April. We tested it again later in April. We can continue to consolidate. We've broken up. We're back above the 50-day moving average. We have broken below the 10-day moving average, which is concerning. It's a low dollar stock. But if you have speculative money and you're looking for where can I get a really good return on speculative money? Now, remember, there's a difference between your money that you're wanting to have good diversification and grow your account over time, et cetera, versus the amount of discretionary income that you allocate to where are the shots I can take, knowing that the risk is higher, but the return can be higher as well. This could play into that. But even with that, I would want to see it back above the 50-day moving average first. So if we can break above the 50-day moving average and you have speculative money, then I think that's a good place to be. But for now, I want to see a little bit of a bounce further.
Second one's going to be Rivian, R-I-V-N.
And gosh, if you've been watching for a while, you've heard me talk about how the car is a lot better than the stock. If you're a car person, you can't help but like the cars. They're really nice looking cars. Well, people have started to figure that out, I think. And as we held down here around 10, and you know the importance of the $10 level, if a stock is highly institutionally owned, only institutions with growth in their investment objective can own stocks at $10. If you break $10, then your investment objective has to be aggressive growth. So obviously this is highly owned in institutions because you can see every time it's come down to 10, it's caught a bid. Well, that was okay, but we kept running into resistance here at the midpoint. I'll give you the exact price there of where I drew the resistance line, about 14, if you will. And so it's okay. You find support, but you bounce up and you bump your head at 14. Now we've broken above that. The issue that I have here with Rivian is we've gone too vertical. I don't like it when things go this vertical. You know, one of the rules is what goes vertically up oftentimes comes vertically back down. We have great separation from the 10-day moving average right now. This could take off and continue to go higher. Maybe at the expense of Tesla. I don't know. We'll have to wait and see. Or maybe this is the next great player. Tesla's into all kinds of things other than electric vehicles. But at this point in time, we're at this resistance area going back to those highs in January. We're too far overbought. I would like to see a little backing and filling here. I would like to see the stock go sideways right here, right around 17. Hold this area, go sideways for several days, let the 10-day moving average catch up, and then if it can break above 17 and a half, I think you have something. Until then, you got to be wary that that was a very vertical move and it could all get retraced rather quickly. So be careful on this one. Let's see if it gives us the Goldilocks scenario of some consolidation under 17 and then breaks higher. Then you're in clean air. And then you could have a great one. So I like the question. I think it's a great one to keep on your watch list, but I wouldn't do anything right now.
Very well. Let's head over to NVIDIA for Will.
All right, well, let's take a look at NVIDIA because it had quite a nice bid, as I'm sure you're aware. And this is what I'm talking about. This would be great for Rivian to do. So we had a quick vertical move because once again, same story I've been talking about. The break down below 140 down to 120 was rather abrupt. And so there was no resistance on the way up. And now we're starting to consolidate here above the 10-day moving average underneath 140. I think NVIDIA here is very interesting. And if we can break above 140, we could have another big run in NVIDIA. It almost seemed to be forgotten for a while. It was like everything that was coming out was on the negative standpoint. We went all the way down to 100. There were all kind of people saying, "Oh, I'd love to be able to buy NVIDIA at 100." Did they? Who knows? But they had their chance, and so they can't come back and say, "Oh, I want another attempt in NVIDIA." They may never get that. There is a chance that we pull back a little bit, at least to the 10-day moving average. The ideal scenario is we continue to consolidate sideways here under 140. We let the 10-day moving average catch up. But Will, for me, to really be excited about NVIDIA again with where we are right now, I want to see it break that 140 level. But yeah, NVIDIA is back in the news. So good on you, Will.
Yes, indeed. Bruce here says Fubo looks very interesting to the upside.
Another one we haven't looked at in a while, and that was, gosh, during the pandemic with all the meme traders, etc. We used to hear Fubo all the time, and then you can see why it went away. It did absolutely nothing since the beginning of the year. We had that big spike up. We came right back down again. Why I don't like the vertical moves. I don't like the separation from the 10-day moving average. And then we've just sat here. Now, understand, based on those rules, we got to get back above 5. So the momentum traders have to drive this stock back above 5. If you're looking for a longer term move here, you need it back above 5 so the aggressive growth investment objective institutions can buy it. They can't even buy it right now. So right now it's just trading on momentum traders. In the short term, it's broken above its major moving averages. The next on the short term, again, I'm talking about the short term. That other analysis was on the longer term. The short term is, I think we probably run to 4 and we might do it rather quickly. After we get to 4, I don't know. There's a lot of resistance there from January, February, and then we fell back down in the beginning of March. But I think at least for now, over the short term of the next couple of weeks, we can move up and test 4 again. That seems likely. But after that, wait and see. But wow, furthering the point of why I love this TradeFinder event so much. A couple more real quick, Zach, and then you're going to need to do the FXI.
Very well. Yeah, we'll get a couple here in and then go over to the platform, as you said. Any idea on GPN?
Let's take a look. Some of these stocks caught a bid. GPN did as well. But all it did was come up and fill the gap and then come back down. And so can we hold this level? This one's a fairly easy read where some of them have been a little cloudier. It needs to hold 80. It's got to hold this 80 level. If it can hold 80, and please note that it's below the 50 and the 10-day moving averages. So that's hands off, unless you're wanting to short it. If it breaks below 80, you probably have a great short all the way down to this wave 3 low in April. But if you're wanting to go long, you want to see it bounce off this 80 level and get back above that 10-day moving average. I would argue it doesn't even have to get above the 50-day yet. That would be more conservative. I like to give aggressive and conservative viewpoints. We all have different risk tolerances. You know what yours are. If you're aggressive minded and it holds 80 and bounces, you could step in. If you're a bit more conservative, let's let it get above the 50-day moving average because it still has this gap up here above 90 to fill. So yeah, that's pretty quick and easy read there. So a couple more real quick, Zach.
We had some chatter in the chat from Lisa and some others around QBTS.
QBTS.
Heading over to the quantum space.
Oh, yeah, that makes sense. They actually were talking about that on the financial networks this morning, and you can see why. AI were the letters, quantum is the next adaptation. And when you look at this, here goes the nice call, Zach, on picking this one because this furthers that rule that I talked about from my mentor, third time's a charm. We got up to this level here I'll give you the exact level on the third attempt here, right at 11 and a half with where that those previous two highs were. And if we break that, it tends to curve for the short to intermediate term. If you follow that rule, you caught this move today. Now, if you're looking at it, well, now we're a little vertical and a little overbought. But I think you could make a good argument that there is a good future here in this stock. But as far as today, I think I would wait. It's too vertical, too fast. Let it hopefully come back and fill a little bit. I wouldn't rule out one more up day. And then you think, oh, I missed out on that. Well, what normally happens, and the market doesn't always do what it normally does, we're going to get a little bit of sideways or backing and filling here. But I think you're in the right space as far as the next big momentum run. I just wouldn't chase it today. Last one.
Last one, let's go with Reddit. That should be an interesting chart to look at that we haven't seen in a while either.
Yeah. What's the symbol? RDDT? Is that Reddit?
That's it. Yep.
Okay. And gosh, I just called them out a few minutes ago. So there's Reddit, and their valuation was insane when they went public. But another fairly easy call. We have this low down here around 75, and we have a second level here where the gap up occurred right at 100. It's pretty easy. If we can hold 100 and get back above the 10-day moving average, similar to what we just talked about, then I think you can go long here. If you're a little more conservative minded, let it get above the 50-day moving average. We did have a pretty quick move down here, so perhaps we could have a pretty nice momentum run. But it needs to show us it can hold 100, and it's got to get it back above the 10-day moving average. I would not chase it right now because there's danger at this point if it breaks below 100 that it comes all the way back down and tests this level down here around 75. So it's danger, danger, Will Robinson right here. But watch it. Keep it again on your watch list. If we can hold 100 and bounce, and it's one of those big round numbers, so it might, and get above the 10-day moving average. If you're aggressively minded, you can step in. If you're more conservatively minded, just give it a little more time and see if it can get above the 50-day moving average. Awesome class. Great questions. Fantastic. Zach, go ahead and show them how to post FXI, and then I got to run.
Sounds great. Yep, we'll get right into it. It'll be short and sweet today, folks. So we'll head over to the platform. Let me take the screen from you, Rob, and should be good to go. Should be good to go now. All right.
There you go.
So let's head over to the toolbar here. We can see the ideas, and we'll come over to see the list of all of our ideas from our ever-growing community. As today's an abbreviated session, not going to go into the usual speech or overall just pitch about the functionality around the platform. Today we're going to go with a post. That's correct, right? Oh,
no, I'm gonna
Boss Rob.
I'm gonna step out, so to speak, literally, and because two of my three indicators are giving it support, we are going to actually make this an idea.
Okay, I'm sorry, I misheard. So scratch that. We will cancel this and go back to an official idea. So this again can be equated to as if you're paper trading with your brokerage. Lots of you have probably heard me say that before, but for anyone that might be new, I always like to make that reference as it's essentially exactly what you would experience given you're with a brokerage and paper trading, therefore not putting any risk on the line or capital, that is. So 37.50 was that target price. Is that correct, Rob?
That is correct.
And the overall time frame we're looking at?
Show them how to make it 2 months. I think
months.
it'll happen within 2 months. It's in a vacuum.
Sounds great. So what Rob's referring to here is we have these fixed intervals of time for you to choose from that are set, but we can go down to custom and go to the very exact day. If there's a different day in mind that's not already provided in those intervals that we saw on that list before. So we said 2 months out. We're at May 20th here, so we'll go to July 20th, which is a Sunday. So I always like to go to the next trading day, which will be July 21st. We'll come back and make this look nice and pretty with lots of supporting details and evidence based on Rob's analysis that he provided a bit earlier in this session. And I will just wrap up by again going over what Rob mentioned, that opposing opinions is what makes markets. If everyone agreed, there'd be no trades, no transactions to take a part of. So whether you agree or disagree, we encourage your opinion, your vote. As you can see, click into the idea now that it's published. It's available for you to come in, give it a thumbs up, a thumbs down, and just support your reasoning either way. And obviously, just staying courteous and just being generous to those in the community. As long as you have a supporting opinion, whether you agree or disagree, by all means, please share it. So I'll pass back over to you, Rob. I know you got to a hard stop, and we'll let you get out of here.
Yep, I'm going to share the screen back, and I just wanted to further what you just said about keeping your comments respectful. And we have yet, the Hub organization has yet to have to censor anybody for speaking out and being, derogatory on somebody else's idea. If you read the social media on some of the others, some of the comments can be really rough and brutal. And the social media aspect of the Hub software is really great. That's why I think this is a community you want to be a part of, where people are respectful of other ideas. They may disagree, and we want that. We want opinions, and they want opinions. I want to see them. But we don't need to trash anybody personally because they have an idea. So what? It's their personal view. So let's respectfully disagree if we disagree and post it. And that's been what's happened. And that's what the Hub organization is trying to build here. So you articulated that very well, Zach. So I just wanted to remind everybody on this chart, no DMI confirmation, but confirmation from both the CCI and the CMF. So two of the three confirming indicators that I look at, in addition to good basic technical analysis, the 1030 bullish break, the break above resistance at 35, and the lack of resistance before 37.5. All those factors allowed it to be an idea rather than just a post. So let's see how it plays out. And with that, Zach, thanks for all your work. Thanks for everybody who attended. I hope to see every one of you in that event tomorrow night. I promise you it'd be a well worth use of your time. It'll be about 45 minutes long, and we will have time for Q&A. And there's going to be some things that I guarantee you don't already know about gold. So hopefully we'll see everybody at 7 p.m. tomorrow night. I got to run now. Thanks again for your attention. Appreciate your time very much. Value it a lot, and look forward to talking.